Everyone, so our next chapter is on national income and national output. This is about, like, you can say, yeah. So it is what it is: national income, national income, and national output. Okay, so these two things I'm describing here. First is key measure for economic growth. So what is the key measure for economic growth? Like if a economy is in a growth, then what we can say? We can say that GDP. Growth is signify the GDP. Okay, so growth is signify the GDP. So economic growth used by all the country around the world is GDP. Gross domestic product is the main feature. First of all, now GDP is the total market value of country's output. What is the output? It's total value. Total value of output is what? That is the GDP. Okay, and it is the market value of all final goods, and it is the market value of all final goods also. So there is the final goods and services. Final goods and services are what called? It's called GDP, produced within a financial year also. So financial year is also important. So what three things we should be like in mind? First is the final product. Okay, so final goods and services. Second is the financial year. So financial year. Okay, and third is the factor of production located within a country, and it should be within a country. So within a country. So three things are there. First is the final goods and services. Second is the financial year, and third is the within a country. Okay, that like factors of production located within a country, irrespective of ownership. Like I can be owner. I can be owner, but that's not necessarily that I can be living in that country. I can be in a Mauritius and my factory is in India. So what GDP? GDP in the territory of that country. That's the GDP. Okay. Now the definition is the like I'm describing about definition. The factor of production and inputs. So what are the factor of productions? Okay. So factor of productions are what? It is the input. First of all, input into the process of production. So first of all, input, the four key factor are land. First is land, second is the labor, and third is the capital, and four is the entrepreneurship. So four things should be in the GDP calculation. In the input we can consider the land, labor, capital, and entrepreneurship. Okay, so land is what? Land pays the rent, so we will get rent from the land. Labor is paid the salaries, so we will get the salaries by the labor. And capital is paid the profit, interest, and profit in payment, so capital will pay the interest and profit also. Okay, and the for entrepreneurship also profit, like entrepreneurship will be for the profit and capital for the interest. So that is the like all about factors of production. Now final goods and services are produced for a final use. What is the final goods and services? That will be produced for the final use, and many goods produced in an economy are not classified as final goods but instead intermediate goods. Like if there is a production, then there can be intermediate goods also. Intermediate goods can be there. Okay, see, these intermediate goods are produced by one firm for use in further processing by another firm. And for example, like tires sold to automobile industry. Like I am purchasing one bread packet. Okay, but what required there? Food grain. So food grain, would farmer will provide food grain, but after food grain will convert in the flour, like it will be converted in the flour also, so that will be the intermediate good. Then this flour will go to the companies, and that flour will convert into the it's converted into the like bread packets. So total intermediate goods will be there. Like if I'm going to make a automobile industry, I'm going to make a car, then there will be tires also, there will be steering also, so that will be the intermediate good, so that can be sold again and again. Also GDP ignores all, like GDP what included it, like there will never be a intermediate good, there will be only the final goods. Like GDP include only the final goods, not intermediate goods. And also GDP ignore all the transaction in which money or goods change hand, but in which no new goods and services are produced. So GDP ignores all the transaction in which money or goods change hand, but in which no new goods and services are produced. So there will be like change in hands, but no new goods and services are produced. So all transaction will be in a money or good change hands, but in no new goods and services are produced. For example, sales of stock and bonds are not counted in GDP. So next thing will be the stock market, like sale of stock or bonds will never be counted in GDP. These exchange are transfer of ownership of asset and do not correspond to the current production, because this is the bonds, this is the shares, and these are not correspondence to the production. That's why this will never be in a GDP. The fee paid to the broker for selling of stock is counted in GDP. Like what is broker is paying for the selling of stock, broker will count in the GDP, but broker will be counted in the GDP. Broker is a performing in its service, so broker will be count as a GDP in a service. Okay, so this is the all about the GDP. Now gross national product, what is the gross national product? Is another measure of economic growth. It is the total market value of all final goods and services produced within a financial year by factor of production owned by country's citizen. So here the what is the important term here is the country's citizen. Citizen is the very important term here. That's why the economic growth in total market value of final goods and services produced within a financial year, it is final production of final within a financial year of total goods and services owned by the country's citizen, regardless of where the output is being produced. Okay, now like if some output is producing in Mauritius, but that is produced by the Indian government countries like persons, then that will be the GNP of India that is considering. The final goods can be classified into two in turn of the national nature of goods, like capital good. First is the capital good. Okay, first will be the capital good. So capital good are those goods produced by economic system that are used as input to produce other goods and service in future. So capital goods thus yield valuable productive services over time. So what is that? This will produce the valuable services within the time. That is the capital goods. Okay, that is the capital goods. And a road is a capital goods. Once it is built, we can drive on it, transport of goods and services over it. So that is the like building equipment and all that is for capital goods. Now consumer goods. What is the consumer good? That goods which we are consuming, like clothing, toys and foods and all that. Okay, and now GNP equal to the, we can see GNP equals to the GDP plus net factor income from abroad. So we will write down the GNP equals to GDP plus net factor income from the abroad. So factor income received abroad by Indian normal resident minus factor income paid to the foreign resident in Indian domestic territory. So what will be the net income from the abroad? This will be the Indian resident is receiving in another country minus the other resident is receiving from our country. So that will be the net factor income from the abroad will be plus GDP, will called as GNP. Now gross versus net. What is the gross versus net? Okay, so it is called the NNP. So NNP equals to GNP minus depreciation. So this is the like NNP equals to GNP minus the depreciation. During the process of production, capital produced in a previous period gradually wear out. There is the wearing out also in the products. So GDP does not give us the true picture of the real production of an economy. GDP include newly produced capital goods but does not take account of capital goods consumed in the production process. The amount by which an asset value falls each period is called the depreciation. So like there is a depreciation also because of that GDP include newly produced capital goods only but does not take account of capital goods consumed in production process. So it include only newly produced capital goods. Okay, that's why we reduce the depreciation from NNP, like GNP minus depreciation equals to NNP. So net national product will be to minus the consumed production process. Okay, net indirect taxes equals to indirect taxes minus subsidy. So now net indirect taxes, which will be indirect taxes minus subsidy, that will be the net indirect taxes in the GDP. Okay, and now indirect taxes minus subsidy include tax such as sales tax, custom duty, license fee, less subsidy that the government pay for which is received no goods and services in return. So that's why net indirect taxes will be the what is the NNP? NNP always will be the NNP at we are counting NLP at factor cost will be the at market price minus indirect taxes minus indirect taxes. That will be the NNP at factor cost. So indirect taxes minus subsidy include taxes such as sale tax, custom duty and license fee less subsidy that the government pay for which it receives no goods and service in return. Factor costs are the actual cost at which goods and services are produced by the firm and industry in economy. What is the factual cost? It is the actual cost which is the goods and services produced in the economy. They are actually the cost of the all factors of production like land, labor, capital, energy, raw material that are used to produce a given quantity of output in a economy. When to these factor cost taxes are added, then it become the market price. So when these all are taxes are included in that factor cost, then this will become the market price, and then we will reduce the indirect taxes from it, and then we will get the NNP at factor cost. So most appropriable measure of national income is what? National income's most appropriable factor is NNP at factor cost. So this is the very important question. It can be in MCQ. What is the national income's most appropriate factor? That will be the NNP at factor cost. Okay, now NNP, now there are three ways of calculating GDP. So first method is the expenditure method. Second method is the consumption method. Okay, and third method is the gross income method. Okay, so three methods are there. First is the expenditure method, second is the consumption method, and third is the income method. So first method is the expenditure method, a method of computing GDP that measures the amount spent on all final goods and during the period. This method is commonly used for calculating GDP for manufacturing sector. So expenditure method is used for the manufacturing. So what is this manufacturing? So manufacturing firms use the expenditure method. Okay, the expenditure method is calculated by the manufacturing firm. The expenditure approach calculates the GDP by acting together four components like GDP equals to C plus I plus G plus X minus M. Okay, so what is the C? C is for the gross private domestic investment, I is for investment, G is for government consumptions, and net export is X, and G is for government consumption, and P is for personal consumption and expenditure. So first of all there will be the personal consumption and expenditure, then will be the investment by the gross private domestic investment, will be included in that, like personal consumption, like we are consuming the durable goods and non-durable goods. And gross private domestic investment means this is the housing, plants, equipments and inventory. And government consumption means local government for final goods and services, central and state and local governments, all that. And then total net export will be the difference between the export and import will be included in expenditure method. Okay, now we are coming to income method. Income method, a method of computing GDP that measures the income. What measures it? It measures the income. So there will be wages. What is the wages? What is the rent? What is the interest? Okay, and profit also. So all these factors included in the final goods, like producing final goods. So wages, the employee will get wages. Rent, land will generate the rent, and interest, there will be the capital, and profit, there will be entrepreneurship. So income method, completely 4 factor will be there in income method. Now we are calculating the gross. What is the gross? Gross minus depreciation equal to called net. Okay, and market price minus net indirect taxes is called the factor cost. Okay, if we are like market price minus net indirect taxes, we are doing minus, then it will be the factor cost. That will be the factor cost. And domestic plus net factor income. Net factor income from abroad will be the national income. Okay, so gross domestic. So we are discussing about the gross domestic product, GDP. GDP at market price minus depreciation will be the net domestic product at market price. Okay, so GDP at market price will be the NDP at market price if minus the depreciation. So GDP at market price minus depreciation will be the NDP at market price. Net domestic product at market price minus net indirect taxes. Now we are minus in the indirect taxes. So we will what get? Net domestic product at factor cost. So if we are subtracting the indirect taxes from the net domestic product, then we will get the NDP at factor cost from the market price. So NDP at factor cost will be the NDP at factor cost plus net factor income. Net factor income from abroad. From abroad will be the net national product. Net national product of factor cost. That will be the formula. That net NDP at factor cost plus net factor income of abroad will be the net national product of factor cost. Okay. Now I am giving the main sector of economy. So what are the sector? There is a primary sector, then there will be the secondary sector, and there will be the tertiary sector. So in primary sector there is like agriculture and natural resources for the mining and all that. Secondary sector there will be the processing of the natural resources, like value addition to the resources, and most cases they are changes the initial resources, like manufacturing of the goods and services. Tertiary sectors include the financial institution, restaurant and schools. This provide the services. So this is the basic difference between the sector of economy. Now value added method and output method. What is that? A method of computing GDP which multiples the final output with the market price. This method is commonly used calculating GDP in primary sector. So value addition method is used in the primary sector to include the output, like we want to final output. So we are including the GDP computing with the value added method. Now per capita income. What is the per capita income? Per capita income equals to national income or national income upon population. population, per capita income equals to national income upon population. So it is the income earned per person in economy. One of the limitation of this measure is that it does not reflect inequality. Distribution of income is not considered. So nominal versus real GDP. Now we are discussing about nominal versus real GDP. One is the nominal GDP. Nominal GDP. Second is the real GDP. Okay, first is the nominal GDP. GDP is calculated by taking the total value of final goods and services in the economy. And if prices of commodity in a current year is taken, then it is called the GDP at current price or nominal. So in current price, if we are calculating the GDP, that is called the nominal GDP, and it does not exclude the changes in the price. Thus it is possible that nominal GDP is changing only due to change in price, and that has no positive effect on economy. So if there is a change in price, then only will be the nominal GDP will change. So the no positive effect on the economy in that case. But in real GDP, comparison on basis of nominal GDP is not very useful, as nominal GDP can increase only due to inflation. So if inflation is there, then only the nominal GDP will be included. Okay, but to overcome this problem, we choose the price of any one year which we can the base year. So we use the base year as a price for that. So that's why we use the 2011 and 12 as a base year, and multiply output produced in every year with this base year. It excludes the impact of change in price, and thus it is called the real GDP. Why it is called the real GDP? Because it excludes the change in the price. That's why. And it is better for comparison as it removes all impact of price change. So there is the no impact of price change in real GDP. Now we are discussing about a base year. Base year. Okay, so base year for examining the performance of the economy in real terms through the measurement of GDP in the real term. First of all, we are measuring in the real term the economy in terms of GDP, like consumption, expenditure, etc. Estimate are prepared at the price of selected year known as the base year. A base year is the year used for comparison for the level of particular economic index. So the rate of inflation, one would make calculation on the base year. The base year is changed periodically in the economy, and currently the base year is 2011 and 12. It should not be too far or too near the current year. So it is base year will be that will be the not be too far or too near to the current year, and it should be a normal year. It should be a normal year, and the year will less number of shocks. Like shocks will be the less number. What is the shocks? Like recession period, 2008 was a shock period. Now this COVID year is a shock period. Okay, so limitation of the GDP concept. What are the limitation of the GDP concept? GDP increases is considered as one of the chief goal of government of macroeconomic policy. However, serious problem arise when we try to use GDP as a measure of happiness. Okay, GDP and social welfare. If crime level go down, society would be better off. But a decrease in crime is not an increase in output of reflection in GDP. Similarly, inequality of income among different sections in society is not reflection of the GDP. So if there is increase in the inequality, that means not that GDP will be increase or decrease. So that is not the like we can't make any relationship over there. Most of the household activity done by the housewife of our country, and it's not included the GDP. Even housewives are doing what housewives are doing. That income is also not included in GDP, and crimes are also not related. Inequality is also not like income among different sections in society is not reflected in the GDP. So these are some limitations of GDP. Okay, and however, when the same job is being done by a third person, such as a nanny or house cleaner, then it get includes in GDP. Like if my mother is doing the work, that income will never be included. But nanny and house cleaner are doing the work, that income will be included. So underground black economy. What is the black economy? Many transactions are missed in the calculation of GDP. If there is a GDP calculation and many transactions are missed in that, that will be called the black economy. Okay, that will be called as a black economy. Even though in principle they should be counted, most illegal transaction like laundered in the legitimate business income that earned but not reported as income for tax, that is the black economy. Tax evasion will be increased in the black economy. Okay, so this is the black and unemployment rate obviously will be increased. So this was the whole about the GDP and growth, and this whole lecture was about the GDP and growth.